Oh, good morning, good morning, good morning. Look at that is another spectacular today. Today is Thursday, October 20th, 2022, and I am Kenny Polcari, your host of the party. And what is happening today? Well, futures which were down have now pointed up, all right? And so it looks like maybe we're going to have another update after yesterday's down day. The 10-year risk-free rate kisses 4.1377%, putting more pressure on stocks yesterday. Solomon, Bezos, and Musk all joining the chorus of maybe it's possible. Oil rises by 2% as crude stockpiles unexpectedly fall, and Joey sells another 15 million barrels of oil. Tesla misses, IBM beats, and what do we have for dinner? We're going to have the Campenelle with spinach, sun-dried tomatoes, and mascarpone cheese. And if you want to add a little something, the sweet sausage is always perfect. July 23rd, 2008 was the last time the 10-year Treasury yielded 4.136%. And if you use the 10-year as the risk-free rate by which you price other assets, you will now realize that the road ahead is full of potholes and opportunity, if you have the guts to hold on, as rising yields will cause some investors to choose safety over risky. Remember, 4% is the line in the sand, right? That many consider to be the tipping point. Yesterday, the 10-year Treasury yielded as much as 4.1377 before settling in at 135. The 2-year Treasury yielded 4.46. The 5-year yielded 4.36. And stocks did what? They sold off. Not big, but potentially getting bigger. The Dow ended the day down 100 or 0.3%. The S&P lost 25 points. The Nasdaq down 92 or 0.8. The Russell gave back 30 points or 1.7%, and the Transfers lost 220 points, also 1.7. St. Louis Fed President Jimmy B spoke to Kathleen Hayes of Bloomberg, telling her that he is pleased that markets are pricing in anticipated interest rate hikes by policymakers, suggesting to me that there's more to go. That he thinks, and maybe others on the committee think, that inflation isn't going away anytime soon, that the transitory has turned into entrenched, and that investors need to wake up and smell the roses. No, it ain't roses. That I am sure of. You feel free to insert any word you like. In fact, if you remember, it was Jimmy B who suggested 2 months ago that he thought the terminal rate, or the neutral rate, was closer to 5%. Rather than the 4.25% that they were telling us, right? If that's the case, we've got room to go. Current Fed fund rates are 3 to 3.25. In order to get us to 4.75 or 5, we need to raise rates by another 1.75%. He then confirmed that he expects the Fed to end its front loading of aggressive interest rate hikes by early next year, before shifting to keeping policies sufficiently restrictive with small adjustments as inflation cools. There's only 2 more meetings this year, one on November 1st and 2nd, the other one on December 13th and 14th. And then the ball drops and it's 2023. The next meeting is then on January 31st and February 1st. Remember, we have 5 more inflation-specific reads between now and the end of the year. The PCE next week, and then again on November 30th. CPI and PPI on November 10th and 15th, and then again on December 9th and 13th. 4 of those reads take place between the November and December meetings, so there's going to be plenty of inflation data to consider. So I guess we need to play the odds. What combination of hikes will get us to 5% by February 1st? And when that happens, we can expect the 10-year is probably going to be more like 6%, and mortgage rates are going to be kissing 10%. And speaking of mortgage rates, yesterday we learned that new weekly mortgage applications fell by 4%, leaving apps down more than 40% year to date. Housing starts fell by 8.1%, more than expected, while building permits, though, rose by 1.4%, which suggests a little bit of a disconnect, but let's run with that. And like they say in the opera, it ain't over till the fat lady sings, and I don't hear her singing, do you? Okay, earnings season has gotten off to a great start. Remarkably, 80% of the reports so far are beating the estimates, at least on the bottom line. Funny how that happens. After analysts slashed and burned estimates heading into the reporting season, we saw the banks all beat. We saw Brian Moynihan of Bank of America seemingly giddy with excitement on Monday as he described how strong the consumer is, all while building up a massive loan loss reserve account to protect the bank against what they expect to be the Jamie Dimon right, CEO of JP Morgan, that Jamie Dimon hurricane causing those same strong consumers to, guess what, default across a range of credit lines, mortgages, HELOCs, revolving credit, adjustable rate loans, etc. And not to be outdone, yesterday brought on Davey Solomon, the CEO at Goldie, and Jeffrey Bezos, executive chairman of Amazon, and Lonnie Musk, who needs no introduction, all warning of the coming, possible, potentially difficult recession lurking just around the corner. I mean, can you use any more adjectives to describe what's already here? In fact, given the probabilities, Bezos said you had to batten down the hatches. Then they join JJ, other Fed members, Treasury Secretary Janet Yellen, and every other global CEO that's doing the same thing, trying to find adjectives to describe what is already here. Not one of them admitting the fact that it's here. We're already in it. I say grow a set of, and stop the madness. I think Joey and Jill, Cammie and Dougie, Nancy and Chucky, Press Secretary KJP, Jared Bernstein, the chief economist and policy advisor to the president, and Brian Deese, director of the National Economic Council, are the only ones that think we aren't in a recession, nor are we even headed for one. Nothing to see here. Just move on. Talk about being blinded by the light. Are you kidding me? After the bell, Tesla reported and missed $1.27 versus the expected $1.32. Although after adjustments, it was $1.05 versus $1.01. Whatever. Margins are under pressure. Demand is slowing. Battery supply constraints remain elevated. The algos took it down 12% in the moments after the report. And this morning it's quoted down $13 at 208, 208.50, leaving it down 49% year to date. The other thing we're hearing, though, is, and don't be surprised, is what the strong dollar and how it's affecting earnings. Because remember, when the big multinationals earn revenues in foreign currencies and then convert those foreign currencies back into dollars, they get less dollars per each foreign currency, which to me is a bit curious. Not that that happens, but because people are concerned about it. Because we know this. This is not new information. Johnson & Johnson was the latest to adjust their forward guidance so just a bit lower because of the stronger dollar, right? And while the stock did end the day slightly lower, down 0.8%, it's nothing to worry about, right? In my opinion, just think about it. Is the strong dollar fundamentally changing the investment thesis for Johnson & Johnson? Does it change their product lineup? Does it cause customers that buy J&J products to stop buying J&J products? Does it change their 2.75% divvy or the fact that they grow the divvy by 6% a year? Hardly. So let's not light your hair on fire. It's Johnson & Johnson. It's big and boring, but it's Johnson & Johnson. IBM, on the other hand, handily beat the estimate, 181 versus 180, even as the currency headwinds roar. They planned better for their announcement, right? They confirmed that their free cash flow estimate of $10 billion, suggesting that demand for software, mainframes, and hybrid cloud services are alive and well. They expect full-year guidance, revenue guidance, to beat the original guidance. The algos took the stock up 4% in the after-hours trading session. This morning, it's quoted up 125.80 to 126.50. FYI, they're also paying you a 5.4% dividend and growing their dividend by 2.5% a year. Again, big and boring, right? Do you start to see a trend here yet? What have I been telling you? Okay, this morning U.S. futures were lower, but they have since turned higher since I wrote this piece, right? The Dow futures are up about 80. The S&Ps are up 5. The NASDAQ and Russell are up appropriately as well. Oil, which has come under pressure over the last couple of days as they tried to sell us on the demand destruction and oversupply story issue, is up today. Even as Joey announced the release of another 15 million barrels of oil from the Strategic Petroleum Reserve in his effort to try and cool the hot energy prices ahead of the midterm elections, telling us this isn't political, leaving that strategic reserve at just 400 million barrels, the lowest point since 1984. And those reports that U.S. crude stockpiles may rise, not happening. Crude stockpiles unexpectedly fell last week. And Joey announced that he's ready to buy oil to replace the reserves when the price of oil falls to $67 a barrel. That's like Uncle Warren Buffett telling you that he's going to buy his Occidental Petroleum before he buys it. No. He tells you after he buys it and watches as all the lemmings jump on board. Wake up, Joey. Oil is not going to $67 a barrel anytime soon, especially now. Remember the European Union ban that starts on December 5th. That's expected to remove 1 million barrels a day from the market, on top of the 2 million barrels a day that the Saudis announced last week. This morning, oil is trading up 2%, taking it to 87.24, a full 23% higher than Joey's announced purchase price. Remember, the kingdom wants oil to be north of $90 a barrel, and they will continue to cut production in order to keep it there. This morning, the dollar index remains at 112.80, 113, and gold's trading around 16.38 an ounce. We're going to get 20 more company reports today, right? Some have already come out, including Telephone, KeyBank, Snap, American Airlines, Blackstone, FCX, Dow, Union Pacific, Whirlpool, Tenet Healthcare, and Boston Beer, SAM, right? Remember how I told you on Monday that while some are calling this latest rally the bottom, I am not in that camp just yet. There's still too much uncertainty, and I think this necessitates caution, which doesn't mean stay away, just means be cautious on how you allocate capital. I do think that we are in a bottoming process, but that doesn't mean I'm calling it the bottom, right? There's a difference there. European stocks are mostly lower, and investors there worry about scorching inflation in the coming recession and the latest departure from the Truss administration. Word is that Truss is toast. This morning, we learned that another cabinet member bit the dust. UK Interior Minister Suella Braverman, right? She resigned after only 43 days, putting even more pressure on Truss. I mean, she managed to destroy her own party in 6 weeks. Even Donald Trump didn't do that. The S&P closed at 36.95 last night, down 24 points as it continues to try and bottom out. Challenges remain for investors. Consensus estimates remain subject to downward revisions, while inflationary trends and hawkish central bankers and a slowing economy are all going to keep investors kind of on the edge of their seat through the year end and certainly into 2023, right? The election, throw in the midterm elections because they'll add some chaos to the equation. Sit tight if you're the long-term investor. Stick to your plan. Take advantage of dollar cost averaging and dividend reinvestment programs and tweak where necessary, right? Doesn't mean blow everything out, just tweak. Overweight the big boring names, right? Buy the stuff that people need. Consumer staples, utilities, healthcare, energy, while underweighting and not eliminating, the other names, right? Tech, basic materials, communications, industrials. Okay. So what do we have for dinner tonight? We're having the Campenelle with sausage and sun-dried tomatoes and mascarpone cheese. And if you really want to make it simple, I have a surprise for you, right? This is maybe a 30-minute recipe. It uses mascarpone cheese, which I'm a big fan of. And it's very versatile, and you can use it in a number of ways in pasta and even dessert dishes. So here's one for your books, and it will become, I'm sure, a family favorite. So for this, you need the Campenelle pasta, and that's like the little bells, right? You need something like that, something kind of interesting. Mascarpone cheese, have to have room temperature so it's nice and soft. You need lemon zest and juice of 1 lemon. You need salt and pepper, olive oil, minced garlic, chopped sun-dried tomatoes, 1 bag of baby spinach. You need toasted breadcrumbs, and of course you need fresh grated Parmigiano cheese. You can either have Parmigiano or Pecorino Romano. You can mix them, you can use one or the other, whatever, as long as it's fresh grated cheese. Begin by combining the lemon zest, the lemon juice, the mascarpone, and some salt and pepper in a bowl. Whisk it to combine it. Make sure it's ready for when you need it. Set it aside. Bring a pot of salted water to a rolling boil. Now add your pasta into the pot. While this is happening, you have about 8 or 9 minutes. Heat up some oil in a skillet and add the garlic and cook it, toast it just for a couple of minutes. You want the garlic to be toasty, not burnt. Once it is, turn the heat off, right? Cook the pasta until it's al dente. Like I said, 8 minutes, maybe 10. You want to strain, always reserving some of the pasta water. Return the pasta to the pot. Set it over medium-low heat. Add a little bit of the pasta water to keep it moist. Now stir in the mascarpone and lemon mixture, the sun-dried tomatoes and the spinach. Add it back. Stir it up. If it sucks up the juice, that's right, add a little bit more of the pasta water and toss it until the spinach is wilted and everything is piping hot. Remember, the heat's on medium-low. And always remember, you can just keep adding a little bit of pasta water just to keep it moist. Serve this immediately in warm bowls, topping each with the grated cheese and some toasted breadcrumbs. Don't overdo it. Well, maybe overdo it a little bit. Listen, you can really add some texture to this dish by sauteing some crumbled Italian sweet sausage and a bit of olive oil and maybe some diced onions. When you're ready, when the pasta's done, you want to add the sausage and the onions when you're putting the whole dish together right at the end, right? When you're mixing everything together, mix it all up and serve it in a nice bowl. It is a really hearty dish. It fills your belly and it makes you smile. In any event, it's another gorgeous day, right? The markets look like they're going to be okay today, but let's see because the day has only begun. Until tomorrow, take good care.